All right, today we're diving deep into the ethical backbone of Islamic finance. We're going to explore the core principles that are all about creating a just and fair economy for everyone involved.
But before we get into the nitty-gritty, let's just step back for a second and ask a really big question, one that every economic system tries to answer. What does a truly fair economy actually look like?
Well, in Islamic economic thinking, the answer really boils down to two huge ideas: protecting people's wealth, that's hifz al-mal, and preventing any kind of harm or exploitation, which is called mafsada. The whole point is to make sure every single deal is fair and totally transparent. So let's see how that big idea gets put into practice.
So here's our game plan. We'll start with the overall blueprint, then we'll break down the 4 big no-nos, and finally, we'll see how this all comes together in the real world.
Okay, first up is the one you've probably heard of, riba. This is the big one, the prohibition of usury or interest.
Now, the key thing to get here is that riba isn't just about loan sharking or super high interest rates. Nope, it's about any guaranteed increase on a loan that's agreed upon beforehand. It forbids the idea that you can earn a guaranteed return just by lending out money, period. It doesn't matter if the rate is tiny.
And this isn't some vague suggestion. It's stated very, very clearly in Scripture. This draws a really sharp line in the sand between legitimate trade, buying and selling actual stuff, and lending money to make more money.
This slide does a great job of showing the practical difference. With a conventional loan, a bank just gives you money and makes its profit from the interest it charges you. But in an Islamic model, like one called murabaha, the bank actually goes and buys the thing you want, let's say it's a car, and then sells that car to you for a slightly higher, pre-agreed price. See the difference? The bank's profit comes from a real sale, not from simply renting out its money.
And this whole idea of fairness goes even deeper than just loans. The first type here, riba al-nasiya, that's the classic loan interest we've been talking about. But then there's riba al-fadl. This one prohibits unequal exchanges of the same thing on the spot. So for instance, you couldn't trade 1 kilogram of really good dates for 2 kilograms of not so good dates. It's designed to stop exploitation even in basic barter.
Okay, let's shift gears to our next principle, qarar. You'll see how this builds on that same foundation of fairness. This one is all about getting rid of major uncertainty or ambiguity in a contract.
Think of qarar as any deal that has so much uncertainty baked into it that it could easily lead to a big fight or one person getting totally ripped off. It's about killing that potential for deception before it even starts.
So where does this pop up? Well, a few key places. Like you can't sell something that doesn't even exist yet. Think selling the calf of a pregnant cow, or selling a pile of clothes without specifying what's in it. In every one of these cases, the contract is basically built on a foundation of who knows.
This old example is actually a brilliant way to understand it. Back in the day, some sales were considered final if a buyer just threw a pebble and it hit a pile of merchandise. You bought whatever the stone hit without even getting a good look at it. That is the exact kind of gamble that qarar is meant to prevent.
Now, here's a really crucial distinction. This isn't about trying to eliminate all risk from business. That's impossible, right? Business is risk. This is about eliminating ambiguity that is created inside the contract itself. It's the difference between taking a calculated business risk and signing a deal that's a total guessing game.
And that idea of prohibited risk leads us straight into our third principle, mazer, which, well, it takes that idea to its logical conclusion, gambling.
At its core, macer is about getting something for nothing but pure luck. It's a zero-sum game. No real value is created, no service is performed. Wealth just moves from the loser to the winner. It's a winner-takes-all situation.
And just like with interest, the prohibition of mazer is spelled out directly in Scripture. It's considered something to avoid because it can breed resentment, and frankly, it's not a productive way to earn a living.
So this principle covers the obvious stuff, like lotteries or betting on a horse race. But it also applies to some complex financial products. And here's where it gets really interesting. This is why conventional insurance is often seen as a problem. Think about it. It has elements of both gambling, macer, and uncertainty, qarar. You're paying money betting that something bad might happen. It's a transaction based on chance.
All right, our fourth and final prohibition is probably the most straightforward of them all. Basically, you can't buy, sell, or finance anything that is itself forbidden, or haram.
The logic here is pretty simple, right? If an activity is off-limits, then making a profit from that activity is also off-limits. The entire economic chain connected to it just becomes invalid.
And this saying just nails it. It perfectly captures how complete the prohibition is. It's not enough to just not consume the forbidden thing yourself. You can't be part of its economic ecosystem at all.
And this has a massive impact on the world of modern investing. It's why something called Shari'ah screening exists. It's a process where investment funds are filtered to make sure they don't include companies that make most of their money from things like alcohol, gambling, or, interestingly, conventional banking.
Okay, that's a lot of theory. So how does any of this actually work in a buzzing modern economy? Well, let's take a quick look at Malaysia, which is a real powerhouse in the global Islamic finance scene.
This table is awesome because it just lays it all out. For every one of the prohibitions we've talked about, the industry has come up with a real, working, ethical alternative. So instead of a credit card that charges interest, you get a card based on a sales contract. Instead of conventional insurance, you have cooperative models where people pool their money to cover each other. It's a whole parallel financial system built from the ground up on these principles.
And really, that's the thought we want to leave you with. You know, when you peel it all back, these ideas, tying finance to real things, making sure contracts are clear, and sharing risk instead of just shifting it onto someone else, these aren't just rules for one group of people. They're all about building an economic system that's designed for justice and shared success. And that's a pretty compelling idea for anyone to think about.